Hi there. Thanks for joining us here at PhillipCapital's Market Watch. I'm Timothy, research analyst from Phillip Securities Research. In this episode, we'll be discussing the outlook for the US big techs for the fourth quarter 2021. We think that the tech market has more room to grow despite recent headwinds in rising interest rates. We see secular trends continue to drive the tech sector outlook. From a macro perspective, although we expect interest rates to rise, we think markets can still perform well. From the chart, we see the relationship between rising interest rates and the stock market performance has historically been unclear. The shaded areas represent periods when interest rates spiked. We see that when interest rates spiked, the Nasdaq blue line still performed positively at times. We think the stock market is more correlated to current economic conditions and may still perform well despite rising interest rates. We also see that despite the market being near all-time highs, big tech valuations, the blue line, are near 5-year lows. The FANG-M, Facebook, Apple, Amazon, Microsoft, and Google valuation premium to the broader tech market Nasdaq index has become relatively narrow. Thus, we think that investors are not overpaying now as the premium of market leaders is historically low. Here are our US tech stock picks. We like Facebook for its growing core business. Monthly average persons, a gauge of the number of unique users on Facebook's platform, is still growing. It is expected to grow 9% year-on-year to reach 3.9 billion users in FY 2022 estimate, mainly driven by Instagram and WhatsApp user growth, which Facebook acquired in 2012 and 2014 respectively. More importantly, average revenue per person is also trending up and is expected to grow 22% in FY 21 to $33.46. Advertisers are paying more for ads on Facebook's platforms. Even during the pandemic in FY20, when consumer spending plummeted, average revenue per person still climbed from $25.57 to $27.51. Ad spend is also boosted by new ad formats and new ads shown per page. Global digital ad revenues is expected to grow 9% compounded annual growth rate to 2025 as the secular shift to digital advertising continues. A risk we see is a new privacy update in Apple's iOS 14 as a concern, as it limits Facebook's ability to track user data. We are monitoring this as a key risk as it affects Facebook's core advertising business model. Facebook has yet to report any impacts to its results. We have a buy rating on Facebook with a target price of $424. We are bullish on Netflix because of the spiking margins and as memberships and prices are growing faster than content costs. Paid memberships reached $204 million in FY20, increasing 22% year-on-year, while average monthly revenue per membership has been growing at a compounded annual growth rate of 6% since FY16. Meanwhile, content costs, Netflix's main cost driver, remained relatively flat. As such, net margins grew more than 5 times from 2% in FY16 to 11% in FY20. We expect memberships to grow 9% year-on-year in FY21 and average monthly revenue per membership to grow 10% year-on-year as Netflix gradually raised subscription prices. We also expect the growing popularity of video demand to support Netflix growth as well. We have an accumulated rating on Netflix with a target price of $724. Our next pick is Apple, which is benefiting from the adoption of 5G technology. Not only are iPhone unit sales volumes expected to be strong as users upgrade from 4G to 5G, but 5G iPhone prices are more than 20% higher than 4G iPhones, as shown by the yellow line, which helps elevate Apple's margins. There is currently a supply crunch in semiconductor chips, which has reported some impact on Apple's production. However, we think impact will be less for Apple as suppliers prioritize larger orders and higher demand for iPhones. One potential overhang for Apple is a new anti-competition ruling which prevents Apple from forcing users to pay through its App Store. Apple takes a 30% cut of every dollar spent through its App Store. We are still unclear on the impact as people may continue to pay via the App Store out of convenience. However, this is a key risk that may affect Apple's App Store business, which contributes a big part of services revenue, amounting to 20% of Apple's total revenue. We have a buy rating on Apple with a target price of $187. Our last pick is Amazon, with much more growth ahead. In cloud computing, Amazon Web Services, or AWS, Amazon's cloud business, is the world's largest cloud provider. We see AWS capturing much of the growth in the cloud market. It is ranked the best in capabilities with competitive pricing and scale to serve global customers like Zoom, Netflix, and even governments as more and more internet-driven services shift to the cloud. The cloud market is forecasted to grow a blistering compounded annual growth rate of 21% to 2025, as it currently represents only an estimated 8% of global IT spend per annum. In digital advertising, new privacy updates by Apple and lawmakers are making it harder for third-party advertisers such as Facebook to track user data. Amazon's digital advertising only relies on first-party data collected from its own Amazon.com website and is thus unaffected by privacy updates. We're already beginning to see advertisers shift ad spending to Amazon, with Amazon's market share increasing from 8% to 10% in 2020. We expect Amazon's high-margin cloud and ads business to drive operating income strongly through FY21 and FY22. We have a buy rating on Amazon with a target price of $4,329. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Leave your comments. Thanks for joining us and see you soon.